I know you've been expecting a pullback. Is this it? A correction even?
Yeah, this is a pullback. This is a nice 7 to 10% across global markets. I mean, it varies from indices to indices. But to your point and to your colleague report, we can see this massive performance over, for example, for Meta, 200% I think last year and 40% this year. So for the stock to drop 25% or 20% or 15%, it just shows that investors baked a lot of good news into these kind of valuations of these stocks. So I believe the drivers of the pullback continue to be intact. We have no certainty, no clarity on interest rate path. We entered the year with 3 cuts. Now some people talking about hike. Geopolitics tension still there, and earnings season is under the way, and we wait to see how companies will report, and the outlook is quite important.
Absolutely, and whether the Fed is going to cut or hike, as you say, next, or how many cuts this year, how have you projected that through the end of 2024?
So, to be honest with you, we were with the consensus that Feds will move fast. However, the nature of the inflation apparently is quite sticky. So, and the economy in the U.S. continue to be resilient. We continue to see yesterday the numbers, the durable good continue to beat, consumer continue to spend. So that put a lid on how fast the Fed will move. We shifted our strategy quite quickly, and we're waiting for the market to digest the news and to reprice this new narrative, or higher for longer.
So if you've been waiting for a pullback, or something more than a pullback, even maybe a correction across the markets, and you've spotted that the market is mispricing perhaps the interest rate outlook, have you been keeping a lot of powder dry?
Absolutely. Absolutely, and we're ready to put money to work, and we're ready to put money into tech stocks. We're ready to put money into growth company across the United States and Europe. But we will be waiting to see when the storm will settle, and I think it's a good opportunity to enter.
Right, because as you point out, we had been trading, at least for tech stocks, at a PE forward ratio of 59 times earnings, and that's down now to something like 34. Is that just the froth taken off, or are we now at reasonable valuations?
I mean, you're talking in aggregate, so it's hard to pinpoint. I mean, for example, Meta is trading at, I think, 25. Tesla is down this year, God knows, I think 40% or something, and it's trading at 50 PE. So it's quite different from one company to another company. The idea is how much these companies will be able to weather the interest rate environment, and not the company themselves, but the consumers and the corporate cycle. Is it going to be resilient? Is it going to be a shallow drop in consumer spending and in corporate spending, and that will reflect obviously on their earnings? I think this is the key rather than the multiples, because current multiples is just a snapshot. The growth trajectory is where we're looking at.
Well, you are looking at AI as a play, but just perhaps not the obvious companies. Can you give us a little bit more detail on where you're looking, and also what geographic area is most attractive now, given that we know the European Central Bank is going to move way before the Fed at this point?
Yeah, but we continue to underweight Europe. We don't think there's much of value there. I mean, you can cherry pick stocks, depends, but from an overall perspective, Europe continues to be more valued from our perspective. You're right, ECB might cut before Fed, but the reason why they are cutting is quite different from why the Federal Reserve is cutting. So they are in the technical recession. The U.S. economy last quarter posted 3.1 GDP growth. This quarter we expecting around 2.5 GDP growth. So the narrative is different, and the reason and the underneath fundamental for both economies are different. And so you ask about
where you're seeing most opportunities, and across AI as well. I know that you are interested in the AI.
So most opportunities we think in a growth stocks away from tech. We find a lot of companies such as Chipotle, for example. They posted solid results overnight, where they deliver a 20-15% consistent growth. So that's not an AI. I mean, they use a lot of technology, but that's away from your typical companies. when you look at AI, you look at a lot of companies that are getting involved, and we would like to be on the side of companies that receiving the capex, not spending the capex, and I think that's a quite important distinguish. And to the point for your colleague who said that all the spendings will eventually go to certain companies, and we would like to be on that side.
In this region, are you seeing opportunities? Because it feels like there are opportunities everywhere you look and everyone is trying to get in, but are there, are they real opportunities?
Yes, absolutely. We like UAE on a selective basis, and we like Saudi a lot. I think Saudi stories continue to be resilient, and I think if you will find a lot of growth stocks in Saudi and mid-cap in Saudi, then you can deliver quite good performance. I think banks this earnings season in the UAE will continue to do well, backed by high sentiments and interest rate environment that created this fat cash flow for banks, and obviously you have the government spending as well. So yeah, a lot of opportunities in the UAE and a lot of opportunities in the Saudis, but you have to do the work.